right, for the day's opening calls, James Gerrish from Shaw & Partners and author of Market Matters joining us now live. James, a very good morning to you. So what did you make of that CBA result? James, I don't think we've got, are you on mute there? No. All right, look, we might try and reconnect. Obviously got an audio problem there with James, but just running
I think
through
we'll get you now, Andrew.
We've got you now. Good one. Okay, James.
My apologies. We're only a couple of years into a pandemic and I'm still on mute.
All right, CBA, what are your thoughts?
Yeah, good result. So you alluded to the fact that they beat in terms of cash profit by about by a small margin. That was up 11% year on year. The market was looking for 9.4 billion at the cash profit line. They printed 9.6. EPS of $5.57 for the full year was above 5.40 expected, and the dividend you also made mention of. 2.10 for the second half. That put the full year dividend at $3.85. That's the biggest dividend. The 2.10 for the second half is the biggest dividend since 2019 and above expectations. So I mean, consensus was at 2.80, but there was some in the market looking for a dividend as low as 3.50 for the full year. So I thought it was a really good result, Andrew.
How did it compare with NAB, who we heard from yesterday?
Well, this is a full year result from CBA, so a lot more detail in terms of the metrics provided. NAB guided to increase costs. So CBA is saying, so their net interest margin is going to be in focus today. So it was down 5 basis points on the half. If you think about, you alluded to cash rates and the benefit of higher cash rates for margin. So in the first half CBA, the average cash rate was 10 basis points. In the second half, it was 24 basis points. So they haven't really seen the benefit of the higher interest rate environment that we've seen. They did talk to slightly increasing cost pressures, but they did say net interest margins are going to expand. If you think of NABs yesterday, they were the result there was all on cost guidance. So they're saying, costs are going to increase 3 to 4% year on year versus 2 to 3% they've previously guided to. So they're all experiencing cost pressures, but from my experience with CBA have a better tech stack. They've got a better core banking system, and their ability to handle cost pressures is over and above those of the other banks. Hence why it trades on a big multiple premium to the others.
All right, so well, I'm making that comparison there, but when you're looking at the big four, yet to hear from the other couple, but is CBA your preferred bank?
Yeah, we own CBA across our portfolios for Market Matters. We've sort of got a barbell approach. We have the most expensive bank in CBA and the cheapest turnaround bank in Bank of Queensland. So CBA trades on over 2 times book. Bank of Queensland trades on about 0.7 times book. So CBA is just the top shelf. You know what you're going to get each report and time it reports. We've seen it again today where it's delivered on that. Bank of Queensland is sort of a self-help story where they're pushing through a new technology for their core banking system, and they need to spend money to improve their business and pick themselves up off the mat, if you like, from being the cheapest, most unliked Aussie bank on the market.
James, reporting season just getting underway, of course. So what else have you got your eye on at the moment?
Yeah, a couple. I was hoping Centuria Capital was going to be out before coming on here, but it's not yet. So to give you an idea around what the market's anticipating for that, so CNI full year result, look for NPAT of 70.2 million and a dividend per share of 10 cents. Of course, we've heard from some of the Centuria satellites, so Centuria Industrial and the Centuria Office. So they were weaker than expected, and they've been soft as a result. Centuria are using some pretty downbeat assumptions in their forecasting for the year ahead, so in terms of higher costs of capital and the like. So Centuria is one we're certainly watching. GrainCorp came out with an earnings upgrade this morning, so just looking at, quickly on that, they're coming out there and saying, the numbers aren't in front of me, but it was a reasonably strong earnings upgrade. So the momentum in that business continues. I think the market was looking for EBITDA of about 660 million. They've come out and said they're going to be between 680 and and 7.30. So that's going to be a well-supported update from those guys. And watch A2 milk as they come out today. So the FDA has deferred their decision on allowing A2 to sell its product into the US. A2 from the rhetoric that they were putting out there thought that was a done deal. It's not, and the stock will get whacked today.
Yeah, in fact, we've already seen that happening in New Zealand at the moment. Overall, James, your expectations for reporting season, I guess, because it's all about looking backwards, of course, but do you feel as though we're going to get some significant guidance there as to what the path is ahead for many of these companies?
Yeah, hopefully. I'd like to see companies, have the confidence to guide. You know when you're dealing with, good companies with management teams that have a great handle on their business will provide guidance. I know the macroeconomic environment is a really tough one. There's a lot of moving parts to it, but it really shows in a complex environment like this, those companies that do have a really strong handle on their business, and also companies with earning streams that are more predictable than others. So that's something we'll be looking for in this reporting season. But overall, I mean, expectations are low, particularly in some parts of the market. So in property, they're low. In discretionary retail, they're low. In resources, they're probably high. We're cycling off some very strong commodity prices. Energy expectations are high. Banks are sort of so in this, middle of the road. So it's all around results relative to expectations. So, the market's pricing in, different things in different parts of the market, I guess, is the way to characterise that, Andrew.
And I was talking earlier just as far as how the Australian share market, just as far as valuations are concerned, how it compares with its global peers. What's your assessment?
So Aussie share market, ASX 200 is trading about 14 times. So, it was as cheap as about 12 times. We've had some earnings revisions on the downside from analysts leading into reporting. So it's pushed the market slightly higher. The US market is on a higher multiple, but it's also got higher growth. And we're seeing more certainty in earnings, it seems, over in the US market. So this quarterly update that the quarterly reporting period that we've just been through in the US has been pretty strong, in my opinion. We've seen a lot more companies that have been managing their complex environment pretty well. Obviously, chip makers didn't overnight, but other parts of the market have been doing so. So, our market remains, it's slightly cheaper than average, not materially so. Probably about fair value, I'd characterise it by at the moment, Andrew.